If interest rates fall this year, most investors will miss one of the biggest bond opportunities in a decade. And they won't even realize it. Because they're diversified. Here's the problem: history shows when rates fall, fixed-rate bonds returned 6.31%. Floating-rate bonds? 1.67%. Same asset class. Massive difference. So today we're breaking down when to focus on fixed-rate bonds, when floating rate wins, when gold makes more sense, when to hold foreign currency, and when diversification is actually costing you money. And yes, I'm going to make a bold prediction at the end. From 1990 to 2025, all-time average returns: floating rate debt, 4.88%. Fixed rate debt, 4.86%. Basically identical long-term. So why does timing matter? Because during rate cycles, the gap explodes. When rates were rising, floating rate returned 4.98%. Fixed rate returned 1.94%. Floating volatility, 2.79%. Fixed volatility, 3.53%. Floating wins clearly. But when rates were falling, floating rate returned 1.67%. Fixed rate returned 6.31%. Floating volatility, 7.37%. Fixed volatility, 4.12%. Fixed rate dominates. This isn't about which is better. It's about where we are in the rate cycle. Bond prices move opposite to interest rates. When rates fall, existing fixed-rate bonds become more valuable. Their prices rise. You earn capital gains. Floating-rate bonds adjust their coupons. They protect you when rates rise. But they don't explode when rates fall. This is why bond investing isn't passive. It's macro positioning. Most advisors say, just diversify. But here's the uncomfortable truth: if you diversify equally across fixed and floating during a rate pivot, you cut your upside in half. Diversification protects you from being wrong. But it also prevents you from being spectacularly right. The real money is made at turning points. If you correctly anticipate a rate cut cycle, you don't just collect yield. You earn capital appreciation. That 6.31% versus 1.67% difference? That compounds fast. But if inflation resurges and you lock into fixed too early, you sit in dead money while floating keeps paying. This is about positioning before the pivot. Best when inflation is falling for 3+ consecutive months. Central bank turns dovish. Growth slowing. Unemployment rising. Yield curve steepening after inversion. Why? Because falling rates equals bond price surge. Opportunity, capital gains plus stable volatility. Risk, inflation surprise rates rise again, price decline. Best when inflation accelerating. Central banks hiking. Growth strong. Fiscal stimulus overheating economy. You benefit from higher coupons. But once rate cuts begin, returns compress quickly. Floating is protection. Fixed is leverage on the rate cycle. Best during recession fear, market panic, credit stress, geopolitical shock. Capital flows into safety. But long-duration government bonds are dangerous if governments overspend. Inflation becomes structural. Debt monetization accelerates. Gold performs best when real interest rates fall. Currency confidence weakens. Debt explodes. Central banks lose credibility. Gold does not yield. Gold is insurance. If governments keep printing and debt expands, gold likely makes new highs. You consider currency exposure when your domestic central bank cuts aggressively. Fiscal deficit widening. Capital leaving the country. Currencies are macro bets. High volatility. High conviction required. Unit trusts, good for outsourcing timing. Bad if managers react slowly. Endowment-style portfolios, best for multi-decade compounding. Not ideal for tactical macro shifts. If your goal is wealth acceleration, passive allocation won't maximize opportunity. Watch these 3 straight months of falling inflation. Yield curve steepening. Credit spreads widening. Central bank tone shift. Energy price spikes. Sudden unemployment jump. These signal regime change. The market moves before the rate cut. Not after. Wild but structured call: we are entering a volatile multi-year regime. Not ultra-low 2010s rates. Not 1970s hyperinflation. But unstable cycles. My prediction: we'll see short-term rate cuts, fixed-rate bond rally. Then inflation surprise rates stabilize higher than pre-2020. Gold likely makes new highs if fiscal expansion continues. The biggest opportunity? Accumulating fixed-rate bonds right before aggressive rate cuts, and exiting before inflation re-accelerates. If your goal is stability, diversify. Income protection, floating. Recession hedge, government bonds. Currency hedge, foreign exposure. Policy distrust, gold. Capital gains, fixed before cuts. If you have no conviction, diversify. If you understand the cycle, position. The bond market doesn't reward loyalty. It rewards timing. Floating and fixed earn the same long-term average, around 4.8%. But during rate cycles? The difference can be 6% versus 1%. And the next pivot may already be forming. The question isn't, should I diversify? The question is, where are we in the cycle? Because that answer determines everything. Well, that's all for this video. Remember to like this video and subscribe to our YouTube channel as your support motivates me to do better. Thank you for watching, and we'll see you again in our next video.